And I know you probably hear people say that the Roth is the best option, but is it really the best option? Just because I invest in Roth, it doesn't mean that Roth is the right option for you. And it's going to depend on your current tax rates, your time horizon to retirement, and your projected retirement income. And I'm going to do some comparisons between how you're taxed now and how you save money on paying taxes later on in your retirement.
It's easier to make the money. It's harder to save it.
I covered most of this when I talked about the traditional TSP, but let me quickly go over the after-tax deductions. Every dollar you put into the Roth portion of your TSP will be in after-tax dollars, which means that you already pay the IRS your fair share now so that you don't worry about it later on. So let me run some scenarios here. I'm going to first do the single individuals, and then I'll do the married couples later on in this video. Let's assume that you're 35 and single, and your gross income is $100,000 a year. After your standard deduction of $14,600, your taxable income is $85,400 based on the 2024 tax brackets. So for the first $11,600, again, will be taxed at 10%, and the next $35,550 will be taxed at 12%, and then the next $38,250 will be taxed at 22%. For the Roth TSP, because you're paying the taxes on the contribution now, you want to assume that you're paying at the highest marginal tax rate. This income scenario shows a 22% marginal tax rate. So let's say that you're contributing $15,000 to your Roth TSP. Multiplying that by 22% in the marginal tax rate is going to be $3,300. You're not going to get billed for this from the IRS or anything, but you're essentially paying $3,300 upfront to the IRS when you make the Roth TSP contribution because you're paying your taxes upfront. But what's awesome about the Roth TSP is that the money you put in will grow tax-free, and then you can withdraw your contributions, earnings, and interest tax-free. So assuming you're 35 years old and starting with $15,000 a year in Roth contributions every year, with a 2% annual inflation increase in contributions, you could grow your Roth TSP to over $1.4 million in tax-free money if the market performs an average of 8% return, right? So what can you do with $1.4 million in tax-free money? Keep in mind that I adjusted the Roth TSP with a 2% annual increase in inflation. So assuming that your federal retirement income is $30,000 a year, Social Security pension is $20,000 a year, and you have some traditional TSP with over $11,000 a year because you have your employer match that went directly to the traditional portion of your TSP. So your total taxable income is $61,750 and your standard deduction is $14,600 under the 2024 tax bracket. Obviously, the standard deduction will increase with inflation in 25 years. But for simplicity's sake, now I'm going to use the 2024 tax brackets. So the first $11,600, again, will be taxed at 10%, and the next $35,000 will be taxed at 12%. Most retirees would like to pay less in taxes in retirement. I'm sure everyone who's watching this can agree with me on this. So the 12% marginal tax rate is a good target rate for someone with $60,000 a year in taxable retirement income. But because every dollar after the $61,750 will be taxed at 22%. But does it really matter? Again, if you go over $8, $5, or $100, not really, right? It will matter more when you hit $1,000 in the 22% marginal tax rate, in my opinion. So if you want to retire with $100,000 a year and pay 12% in marginal tax rate, this is where the Roth TSP comes into play. Using the same scenario with $1.4 million invested in the Roth TSP, the 2% withdrawal rate will give you $28,000 a year tax-free. A 3% withdrawal rate will give you $42,000 a year tax-free. And a 4% withdrawal rate, again, that would be $56,000 a year, depending on how your portfolio is diversified and grows annually. So with $61,000 a year in taxable income, and $42,000 a year in tax-free income. That's over $100,000 a year in retirement income. In 25 years, this is all going to be adjusted with inflation. And assuming that the Tax Cuts and Jobs Act, if you remember from 2017, or TCJA, remains in place with the current tax rates past 2025, you have to remember that the tax rates will get lower and lower because the IRS is adjusting it by inflation every single year. The threshold for the marginal tax rates will change every year. So the standard deduction will also increase every year. However, and this is a big however, if Congress decides not to extend President Trump's Tax Cuts and Jobs Act from 2017, which ends on December 31st, 2025, then the marginal tax rates will go back to the previous levels. The first tax bracket will remain the same at 10%, but the second bracket will change from 12 to 15%. That is a significant increase. The 22% bracket will change to 25%, 24% will go to 28%, 32% will go to 33%, and then 37% will change back to 39.6%. I don't know what Congress will do in 2025, but I do know that we are in the election season at the time of recording this video. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. Let me give you one more scenario. Assuming that you are married and filing your taxes jointly during your retirement. Let's say you're going to collect $33,000 a year in federal employee pension income, $25,000 a year for each spouse from Social Security, and $40,000 a year combined from your traditional TSP and your spouse's traditional 401k. Your total gross income will be $123,500. And I'm going to use the 2024 standard deduction for married couples, which is $29,200. So the first $23,200 will be taxed at 10%, and the next $71,000 will be taxed at 12%. Your total taxes are significantly lower than single individuals. Your gross income at $123,500 will only put you at 12% marginal tax rate, assuming that you're married going into your retirement. And the first dollar after $123,500 is taxed at 22% for the year 2024. So if you and your spouse feel like you need more in retirement, you could use your Roth TSP to supplement your retirement income to maintain the 12% marginal tax rate. That $1.4 million is completely tax-free after the age of 59.5. So just withdrawing 2% will give you $28,000 a year from the Roth TSP. That'll give you $151,000 a year in retirement income, but still maintain that 12% marginal tax rate. A 3% withdrawal rate will give you $42,000 a year in tax-free income, or $165,000 a year, right? That's still maintaining that 12% marginal tax rate. How incredible would that be? And most of you watching my videos are somewhere in between 22 and 24% in marginal tax rate. Is the Roth TSP contribution always right for you? Not necessarily. I would strongly argue that if you're close to the 32% marginal tax rate, or at the top end of the 24% marginal tax rate, then I would probably consider mixing both traditional and Roth to bring the tax rate down to 24%. And this is not in any form of financial or tax advice. I strongly encourage you to get with your CPA or whoever does the taxes for you to find out your marginal tax rate. So let's show some math here. In the year 2024, the maximum personal contribution for TSP is $23,000 if you're under the age of 50. At the 22% marginal tax rate, I would give up the tax break of $5,000 this year for contributing to my Roth TSP. At the 24% marginal tax rate, I would give up about $5,500 in tax break for contributing to my Roth TSP. But some Roth investors would argue, and I would argue that too, that the tax breaks you give up now is just a little tax bill because the compound interest that will grow inside the Roth TSP will far outgrow these tax breaks. This is when you should use a compound interest calculator to find out how much your TSP could grow in the next 10, 15, 20, or 30 years. Will the interest and earnings outgrow your annual tax breaks? You can always schedule a free session with me by visiting firesightchat.com/coaching. And here are some additional considerations you should have when it comes to Roth versus traditional. You can use the tax calculator to find out how much of your contribution can reduce your taxes now by splitting the taxes. If you decide to do both traditional and Roth, keep in mind that the TSP contribution limit is a combination of both Roth and traditional. If you invest, let's say, $15,000 in your Roth TSP, then you can only invest up to $8,000 in your traditional TSP if you're under the age of 50. And something else to consider is the state you're going to be retiring in? Does it come with state income tax? And some states don't tax your traditional TSP distribution, so be sure to look that up on your state website. You should also consider your retirement age. If your time horizon is like 20 or 30 years, you should calculate to find out if your interest and earnings will outgrow your annual tax breaks. You can download my TSP calculator for absolutely free by visiting firesightchat.com/resources. And if you're a first responder, you have different TSP distribution rules. So be sure to look that up on the OPM website. You should also keep in mind that you can't shelter tax breaks in your traditional TSP forever. Every traditional account comes with what's called required minimum distributions. Your Roth TSP doesn't have that. Okay, most of us will have to start paying taxes on our traditional TSP starting at the age of 72 or 73. You can't avoid it because you're going to have employer matches in your traditional TSP unless they make some changes to the rules soon. And you can also avoid RMD by converting the traditional to Roth after you retire from the workforce. And if you're married and filing your taxes jointly, don't just calculate your retirement income, but also calculate your spouse's retirement income. Even if your spouse is unemployed, your spouse could still contribute to what's called a spousal Roth IRA. You can essentially double your Roth IRA contributions and increase your tax-free income. And I know this was a lot of information. Be sure to check out my TSP playlist on my YouTube page, and you can find different strategies with CSI, G, and F funds. You can find my complete TSP tutorial so that you can achieve financial independence and retire early. And this has been another beast of a video, and I hope you got a lot out of it.